Welcome to the deep dive. Today, we're really zeroing in on something absolutely crucial: capital management.
Yeah, it's a big one.
It truly is. It's what, separates real trading from just, well, gambling.
Exactly.
Getting this wrong is like building on quicksand, frankly.
Yeah.
So we want to explore why managing your capital is key, but also get specific about when to trade.
And maybe even more importantly, when not to.
Precisely. When to just step back.
So that's the mission for this deep dive, right? To unpack capital management systematically. Not just the what, but the when. When should you get in and when should you absolutely stay out?
Okay.
And for this, we're drawing insights from capital management. Trading when prudent and not. It gives a really focused look at this whole area.
Great. So let's kick this off. When we talk about capital management, what exactly are we getting at? It feels like it's bigger than just a couple of rules.
Oh, it absolutely is. Much bigger. It goes way beyond just, setting a stop loss or picking a lot size.
Dude, yeah.
It's really a discipline, a mindset even. Its whole purpose is keeping your trading capital alive, protecting it.
Protecting it
From that one catastrophic trade or, a string of bad ones
Yeah.
that could just wipe you out, force you out of the market entirely. Think of it like the ultimate survival guide for your trading.
The survival guide.
Yeah.
I like that. So what are the sort of core principles then? How do we actually practice this discipline?
Okay, well, the absolute heart of it is fixing your risk per trade rigorously.
Okay.
We're talking a really small percentage of your total capital, like 1 to 2% max.
1 to 2%.
So let's make that concrete. Say you have 1 lakh in capital, that's 100,000 INR.
Okay.
Your risk on any single trade, it shouldn't be more than 1,000. That one rule, if you stick to it, dramatically changes your odds long term.
That's a clear boundary. What else?
Second big one, position sizing. How much you trade, the lot size. It shouldn't just be based on how good a signal looks.
Wow.
It has to be determined by your risk capacity, tied directly to that 1-2% rule we just talked about.
So the risk dictates the size, not the other way around.
Exactly. And then there's something I think many traders struggle with.
I think I know where you're going with this. That urge after a loss.
Revenge trading, yes. It's incredibly dangerous. Doubling down, trying to win it back immediately.
We've all felt that pull, I imagine.
Of course. But it's a trap, an emotional one that just overrides logic. It's almost perfectly designed to, well, make your losses bigger faster.
So avoiding that is key.
Absolutely crucial. Remember, trading success isn't about being right every time. It's about not being catastrophically wrong. Revenge trading pretty much guarantees you will be, eventually.
Okay. What else is part of this survival guide?
And finally, you need to be really aware of your capital drawdown.
Drawdown, meaning the dip in your overall capital.
Precisely. If your total capital falls by, say, 20% or maybe 30%, that's a big red flag.
A signal to
take a break. Step away, seriously.
Yeah.
Trying to push harder when you're down that much almost always leads to digging a deeper hole. It protects your money, sure, but also your mental state, your psychology.
That really drives home the stakes, doesn't it?
Oh.
It's about protecting everything: money, mind, the ability to even keep trading.
Yeah.
Which brings us to, I think, a really critical point. What tells us not to trade? Because it sounds like knowing when to sit on your hands is just as valuable.
You absolutely hear it there. In those situations, saving your money is making money or, well, preventing losses, which amounts to the same thing long term.
So what are those specific situations? When should we definitely stay out?
Okay, there are a few clear ones. First, your emotional state. If you're feeling angry, maybe bored, even overconfident after a few wins.
Overconfidence, that's a sneaky one.
Very sneaky. Any of those strong emotions cloud your judgment. So step away. Second, unclear market conditions, meaning there's no clear setup according to your strategy on the chart. Or the market's just chopping sideways, No real direction. There's no edge there. Don't force it.
Makes sense. No clear signal, no trade.
Right. Third, watch out for that overtrading mood. You feel tempted to just keep clicking, maybe taking 10 trades in a day.
Yeah, feeling like you have to be doing something.
Exactly. But you need to remember, the market isn't always offering great opportunities. It doesn't always trend. Trading less is often more profitable. It's not required to trade every single day.
Good reminder. Any others?
And a really critical one, avoid trading around major high-impact news events.
Like central bank announcements.
Precisely. Think RBI policy decisions, US Fed rate announcements, things like that. Unless you are a very specific type of trader, like a highly disciplined scalper who knows exactly how to play that volatility,
Which most people aren't.
which most aren't, no. For most traders, it's just a minefield. Too unpredictable. Better to wait until the dust settles.
That's a very practical list of don'ts. So let's flip it. What about the dose? When should we be looking for an entry? What signals a good environment?
Okay, so on the positive side, the conditions are just as clear, really. You should only be looking to trade when your specific defined strategy gives you a clear setup.
Your predefined edge.
Your edge, yes, and the signal needs to be confirmed. Unambiguous. Don't jump the gun.
Okay. Clarity is key.
Absolutely. And just as important, the potential trade must offer a favorable risk-reward ratio. We're talking a minimum of 1 to 2, ideally 1 to 3, or even better.
So the potential gain should significantly outweigh the risk you defined earlier.
Significantly. Otherwise, even if you win more often than you lose, it might not be profitable long-term. Then your emotional state again. But this time, it needs to be stable, calm.
The opposite of the don't trade state.
Exactly. You need to be able to make decisions based on logic, on your rules, not on fear or greed or excitement.
The discipline.
Logic over emotion. Always. And finally, it ties back to the start. Your capital should be, relatively safe. Your drawdown low. Your confidence shouldn't come from just getting lucky on a few trades.
Right.
It should come from actually following your rules, sticking to your process. When all that aligns, clear setup, good risk-reward, calm mind, protected capital, that's when you're in the right place to consider entering the market.
Okay, that paints a really clear picture. This has been incredibly helpful, I think, boiling down these big ideas into practical steps.
Yeah.
For everyone listening, could you maybe just summarize the absolute must-know capital management tips we've covered?
Sure. Let's recap the vitals. Number 1, always risk only a small fixed percentage of your capital per trade, that 1-2% rule.
Okay.
Number 2, define your position size based on that risk capacity, not just how tempting a signal looks.
Risk dictates size. Got it.
Third, be patient. Stay out if the market's unclear or your setup isn't there. Don't force trades.
Patience is a strategy.
It really is. Fourth, remember that taking a break, stepping away, especially after a drawdown, is smart. It's not weakness. It's a valid, often effective strategy for survival.
Protect your mental capital, too.
Exactly. Fifth, trade based on logic and discipline. Keep emotions out of the decision-making process as much as humanly possible. And maybe the overarching point. Remember, the goal is long-term survival and sustainability.
Not just making a profit today.
Not just today, no. It's about being able to trade tomorrow, next week, next year. Staying in the game for the long haul.
Fantastic summary. We really hope that this deep dive has given you some valuable, maybe even transformative insights into capital management. It's just so fundamental.
It truly is. And maybe one final thought to leave you with.
Please.
The market, it'll be open again tomorrow. But if your
Wow.
capital is gone today, you won't be there to trade it.
That really puts it in perspective. A powerful thought to mull over. We definitely encourage you to think about your own approach to capital management after hearing this. How might these ideas change your decisions going forward? Keep learning, keep refining.